So guys, today we'll be talking about the trade entry. The trade entry. Remember we talked about the key level areas when trading the forex trading market. And the key level areas I mentioned are the market structure, the moving average, and the order block, which most times you find it in between the moving average and the market structure. Now, what I want you to understand in the trade entry is this. The market maker will always take price to all this region in order for them to do what? Continue moving. For example, we'll make use of a bullish market. When price goes up, fall down, this particular place where we have this particular support is either one of these three. One of these three. So what you want to be seeing is waiting for price to get to this level area. Then you push it back up. Break market structure this high. Create another low for your market structure level. Now, there's something you have to understand. Whenever they get to this place, and there is not enough trade buyers in order for price to shoot up, they will do what? They will close below this region, then come down, either to the next market structure level. Remember, this level might be our moving average level. Then they will bring it down to the market structure level. Then they will go back up again. Now, the key level areas are places where you want to take your entry from. These are the junction where you want to take your entries from. The junction. And it is at this particular place that you can do what? Interpret, put in your Y-curve readings. For those of you asking about Y-curve, it's at this particular place you can put in your Y-curve reading. In the sense that it is at this particular place, let's assume this is 1 hour time frame. When you go down to a 15 minutes time frame, you will see a clearer view of Y-curve. Yeah. And when you do see that, you see the breakout, then price will go back up. The same thing happened to the bearish side. So your trade entry always must come from the market structure region, your moving average region, or the other blocks region. Now, this is what they do. When they take price to, let's assume, the moving average level, this is our MA level, and this is our main time frame. When they get to the moving average level on our main time frame, you have to switch over to the primary time frame. In switching over to the primary time frame, the PTF, what you are looking for in the PTF is this. Price rejecting at the particular PTF. Now, if this is our main time frame, the price gets to our main time frame, you want to come down to the PTF and look for what? A divergence. Is there a divergence in the PTF? If there is divergence in PTF, then you have to go down to the entry time frame to also spot for your what? This is our entry time frame. To also spot your what? Your divergence and your break in the market structure. Then the market continue. So this is our main time frame, this is our PTF, and this is our entry time frame. Now in your main time frame, you want to spot your divergence. Yes. In spotting your divergence in your main time frame, you also want to take note of the market structure level in your main time frame. Now when you go down to your PTF, divergence in your PTF, your entry time frame, rather your ETF, your entry time frame will take you further to the what? To your main PTF level, which is this particular place, the PTF market structure level. Now when price breaks through your PTF market structure level, it will now go back to give you what? Your main time frame target or the continuation of the trend. So it is all about refinement. Whenever you want to refine your entry, your main time frame, you have your primary time frame. You can take your trade at the break of the primary time frame market structure, continue trading the trend, or you refine it down to the what? To the entry time frame. This is what you want to see on your trading entries. The same thing happens for the sell side. For the sell side, we still have what? Just a reversal. This is what will happen. This is always what is going to happen. So whatever they do here in the main time frame is to hit their what? Their target. Either the market structure, the moving average, or the other block. Then they will go down, you will go down to the primary time frame, spot for your divergence and wait for the break of market structure. Then after that, you come down to your entry time frame to refine your entry or to join the trend. Now let's assume this is the weekly time frame chart. The weekly time frame chart. And we have a breakout, let's say a double bottom breakout. Price went up. Give us the market structure level. You take your entry here. Another market structure, another entry. Another entry. Another entry. Until there is another divergence and a reversal. Then you know the market is going into a bearish side. This is technically how the market works. It starts with a divergence, a confirmed divergence, and ends with another confirmed divergence. But what you want to take note of is this. Your entry point is always at the retracement level. Either you enter on the retracement level, refer back to our video. Either you enter what? On the retracement level, the deep one, or you enter at the breakout first. Breakout, then the retracement level. And don't forget, on the breakout, we might have a rectangle form pattern. And there might not be a divergence in the rectangle pattern. But in as much as we have a breakout on the main time frame, you are good to go. But in the retracement level, there will always be what? A fall. A, B, C formation. This is going to happen here. This is going to happen here. They can change their hand. That is why in Elliott wave they will say when wave 1 is sharp, when wave 2 is sharp, wave 4 is always what? Rough. Or when wave 2 is rough, wave 4 will be what? Sharp. So they come in what? Two different styles. Either they come with a rectangle pattern or they come with what? A retracement pattern. But one thing you want to do is ensure you are taking your trade from the market structure, the moving average, or the other block region, and ensure that there is what? A divergence, a break in market structure before you follow the trend. This is it on the trade entry. It is this simple. Let's just assume you want to take a bus traveling to a particular region. This is it. They will build a course. And in building that course, what are they doing? They are trying to look for passengers, calling their passengers. Then the bus gets filled up. They form their Wyckoff pattern in looking for the course. The bus got filled up. Then what happened next? They break out to tell you that we are ready to move. Now in moving, remember everybody will drop at a particular junction. Now when somebody drop at a particular junction, that is another what? Avenue to do what? To join the journey. Now this junction is the what? The market structure it will always create. The market structure it will always create. This same junction is what? The moving average level it will retrace to. This same junction is what? The other block level price is likely to retrace to. So this is what they will do. They will keep on dropping, coming down to pick a passenger, dropping, coming down to pick a passenger, dropping, coming down to pick a passenger, until they offload everybody here with another what? Course. They will do another course, offload everybody here. And when they offload everybody here, you go back to our video when I talk about reversal, you understand this better. They will do what? They will now reverse price, then start the journey all over again, back to wherever they are going to. This